Now speaking, Christina Chang, Vice President, Investor Relations. Welcome everyone to our second quarter 2023 earnings conference call. Our results for the quarter reflect our strategic priorities and our commitment to delivering long-term value to our shareholders. We are pleased to report that our adjusted net income was $1.2 billion, up 8% year-over-year. Our revenue grew by 6% year-over-year to $7.5 billion. We also saw strong growth in our core businesses, with our digital services business growing by 10% year-over-year. We are also pleased to report that our cash flow from operations was $1.3 billion, up 11% year-over-year. We are confident that our investments in new initiatives and projects will continue to drive long-term value for our shareholders. We remain focused on delivering sustainable growth and profitability in the future. Now speaking, Mike Hsu, Chairman and Chief Executive Officer. We had a successful quarter with 5% organic growth and 380 basis points increase in adjusted gross margin. This resulted in a 17% increase in adjusted operating profit and a 23% increase in adjusted earnings per share. We are raising our full year 2023 outlook to 3% to 5% organic growth and 10% to 14% adjusted EPS growth. Our categories remain healthy with North America category sales up 8%. We are seeing double-digit growth in Latin America and strong growth in key developed markets such as the UK and South Korea. We are strengthening our price tag offering and accelerating innovation in technology to deliver a superior value proposition to consumers. We are seeing sequential improvement in market share in key cohorts including North America, where we've seen improvement in 5 of 8 categories. We have purchased Softex Indonesia to expand our presence in the personal care market and are committed to this business for the long term. Now speaking, Nelson Urdaneta, Chief Financial Officer. This quarter, we closed the sale of our Brazil tissue business, resulting in a pre-tax gain of $74 million and $30 million of related expenses. We also recorded a pre-tax non-cash impairment charge of $658 million, primarily related to intangible assets linked to the Softex acquisition. Net sales for the quarter were $5.1 billion, up 1%, with organic sales increasing 5%. Operating profit for the quarter increased 17% and operating margin improved by 190 basis points to 14.2%. Adjusted earnings increased by 23% to $1.65 per share. We are raising our full-year guidance for organic growth of 3% to 5% and adjusted EPS growth of 10% to 14%. We expect input costs to be a headwind of approximately $100 million, an improvement versus the midpoint of our prior outlook of $100 million to $200 million. We also expect advertising spend to increase by approximately 100 basis points for the full year, resulting in a projected operating profit growth in the low double-digit range and an operating margin increase of approximately 150 basis points at the midpoint of our guidance range. Barclays analyst Lauren Lieberman inquired, "Could you please explain what is driving the deceleration in consumer tissue margins in the path to recovery?" Mike Hsu replied, "Yes, absolutely. Year-over-year, we saw a significant increase in gross margins for the segment, up by 200 basis points. Quarter-over-quarter, there may be some fluctuations due to mix and other factors, but overall, we are seeing an upward trend in recovery of margins." Barclays analyst Lauren Lieberman inquired, "Can you provide more insight into your plans for reinvestment and how it will affect the business?" Nelson Urdaneta replied, "Yes, absolutely. We are seeing some positive results from the transition to the new artwork and upgrades in Cottonelle in North America, as well as initiatives in the UK with Andrex. The transition on shelf is taking a bit longer than expected, but overall, we are seeing progress." Mike, do you have anything else to add? Mike Hsu replied, "Lauren, we are seeing great success in our consumer tissue, personal care, and professional businesses around the world. We have invested in these areas and it is paying off. In the UK, organic growth was up double digits and share remains strong for Andrex. We have upgraded the quality of our products over the last couple of years and this has been reflected in our 190 basis points increase in between the lines investment year on year. We are confident in our commercial programming and believe that our investments will continue to pay off." Barclays analyst Lauren Lieberman inquired, "What is the risk of pricing pressure in consumer tissues in Europe and the US?" Mike Hsu replied, "I'd say overall, our pricing initiatives and net revenue management initiatives are on track across our business. We're aware of the same discussions and pressure, and may see more promotional activity than in the past 6 months, but it's not showing up in the results yet." Demand was up double digits in Western Europe, with organic growth also up double digits. "We feel good about where we are, but recognize the competitive environment. We've invested in enhancing our revenue growth management analytics, so we can make the right investments at the right time." Evercore IC analyst Javier Escalante inquired, "Can you explain the difference between Kimberly Clark and Procter in terms of their international tissue business, and what is the margin profile of the consumer tissue in the US compared to the international tissue business?" Mike Xu replied, yes, our between-the-lines expenses are a large part of our budget. This includes both advertising and general administrative costs. Nelson, would you like to comment further? Nelson Urdaneta replied, in terms of the increase in expenses, about half of it is related to advertising and promotional activities, and the other half is due to investments in capabilities such as revenue growth management, digital upgrades, and migration to S/4HANA. Additionally, labor inflation is impacting overhead costs and compensation increases. Mike Xu replied, we remain committed to all our businesses and segments, but we are aware that performance in consumer tissue can be variable. We have strong, profitable international businesses, and our decision to exit Brazil tissue was specific to the conditions in Brazil. We are looking to add businesses with a focus on personal care, particularly in international markets with growth opportunities, such as Indonesia. However, there are other markets that are more structurally challenged, such as Brazil tissue, which we felt would be better served by Suzano than us. We will make decisions based on local market conditions to ensure our brands remain competitive for the long term. Evercore IC analyst Javier Escalante inquired, could you provide us with an update on your plans for divesting tissue businesses in countries where you have large personal care businesses? Mike Xu replied, Javier, while we are comfortable with our businesses and how they're performing, we will stay close to local market conditions and make sure our businesses are performing. Performance is a key factor for us and we will continue to monitor it closely. Wells Fargo Securities analyst Chris Carey inquired, what are your expectations for price mix versus volumes for the full year, and how are you thinking about spending to reaccelerate volumes? Mike Xu replied, we're pleased with our volume trends. We moved relatively early on pricing last year, and we expect to see our volume trends continue to improve as we cycle the price element of the P&L in the back half of the year. Our market share is a little soft, at just below 40% of our cohorts, which is lower than we'd like. This is due to competition scraping us on pricing, as well as cycling a host of one-offs and supply challenges. We're committed to investing more behind our brands, driving consumers to try our products, and having them stay because they like the quality. We're not focused on driving promotion to earn back share, but rather on earning it for the long term. Nelson Urdaneta replied, yeah, we've seen an improvement in volume trends. In Q4 of last year, volumes were down 7%, Q1 of this year, volumes were down 5%, and Q2, the quarter we just closed, volumes were down 3%. We took many of the actions to deal with inflation in the first half of last year, and as we move into Q3 and Q4, we expect to begin lapping some of them. We project that volumes will continue to improve on a sequential basis as the year progresses, and the impact of revenue management actions should decrease. We've already seen that from a sequential quarter, Q1 to Q2, and we expect mix to remain about a point. Wells Fargo Securities analyst Chris Carey inquired, can you provide more detail on the inflation and deflationary trends you are seeing in Q3 and Q4? Nelson Urdaneta replied, so, to summarize, we're expecting a $90 million benefit from input cost inflation in the second half of the year. This is compared to our April forecast of $50 million. We're seeing a mid-teens decrease in the overall fiber complex, and distribution costs are flat year over year. The biggest decrease is in the resin complex, which is down 50% for the quarter and 40% year over year. Mike Xu replied, yeah, the cost environment has stabilized and that's great news for us. After cycling through 2021 and 2022 with record inflation, we're now in a more manageable situation. Input costs have stabilized and supply issues, while still sporadic, have improved. We're optimistic about the road ahead. Morgan Stanley analyst R. Mohsenian inquired, can you provide some context on the U.S. scanner data for consumer tissue and diapers, and what plans do you have to drive improved share trends going forward? Mike Xu replied, yes, Dara, I'm confident that our shares will improve. We have seen positive results from our programming and innovation this year. The recent softness is mainly due to the rapid price increases we experienced last year. In North America, we are facing a tough comparison to the 14% growth we saw in the year-ago quarter. This was due to supply constraints in the first and second quarters of 2021, which led to restocking and reselling impacts in the year-ago quarter. Our shares were higher than usual in the year-ago quarter due to these effects. We are not satisfied with our share performance and are committed to increasing it. We are investing in our brands and engaging with consumers to encourage them to try our products and return. Morgan Stanley analyst R. Mohsenian inquired, can you provide insight into how innovation will contribute to sales growth over the next couple of years compared to the last couple of years? Mike Xu replied, our contribution to sales from innovation last year was among the highest in the industry. We track two internal metrics, net incrementality and % of sales related to innovation. We saw strong results in China, with organic sales up nearly double digits against a backdrop of category decline. We've doubled our super premium mix over the last year and launched two exciting products, Cottonelle 6 Funnel, featuring a 2-zone liner, and Oxygen Bar Pro, a highly breathable diaper. We're bringing these technologies around the world. RBC Capital Markets analyst Nick Modi inquired, Mike, what is your reaction to the feedback from the retail community that there will be a lot of active innovation this year and into 2024 due to products not launched during the COVID timeframe? Could we see unexpected levels of spending to compete with other active innovation pipelines given shelf space is finite? Mike Hsu replied, we are confident in our investment levels, which have significantly increased over the past 5 years. Our current year-to-date growth of 190 basis points is primarily driven by increased advertising investment to support innovation. We are focused on addressing important consumer needs in categories such as diapers and adult care, including absorption, protection, skin health, solid waste management, comfort, fit, and breathability. We have shared our innovation plans with our customers, who are highly supportive. While there may be innovation from other manufacturers in the category, our priority is to drive conversion in the minds of consumers through our own significant innovations. Bank of America Merrill Lynch analyst Anna Lizzle inquired, how are you viewing the health of the consumer and what trends should we expect in Q3 and Q4 regarding volumes and pricing? Mike Hsu replied, consumer demand remains resilient, with North American consumers across our categories in the high single digits, Western Europe in the teens, and Latin America in double digits. Elasticity impact has been muted, with price up 6% and volume up 1%. We expect volume trends to improve in the back half, driven by commercial programming innovation. We're seeing pockets of premium growth in developed markets like the US, China, Brazil, and Argentina, but some downturning in Southeast Asia and Latin America. We're adjusting counts, sharpening entry price points, and cascading innovation through our tiers from premium to value to serve all consumers. Bank of America Merrill Lynch analyst Anna Lizzle inquired, what is your current level of marketing spend compared to peers, and do you feel it is efficient? Mike Hsu replied, we've invested heavily in marketing analytics and ROI over the last few years, and we're seeing good returns on our investments. We've increased our advertising spending by a few hundred basis points in the last 5 years, and we're pleased with the progress but still looking to improve. We're focused on driving revenue, volume 1009, and innovation, as we believe this is the best way to grow our category and serve our consumers. Nelson Urdaneta replied, Anna, it's important to note that our investment levels vary across our 3 segments. We disclose a total number for the company, but the investment behind KC Professional is much lower than what we're doing on personal care. Additionally, our investment in consumer tissue varies by market. We are very focused on return on investment and making sure we are efficient with our spending. JP Morgan Chase & Company analyst Andrea Teixeira inquired, what are you expecting for the third quarter and fourth quarter in terms of organic volume growth? What is the impact of the $9 million benefit from prior outlook on gross margin and EPS guidance? Mike Hsu replied, thanks for the question, Andrea. I'm expecting an inflection in volume at some point. Pre-COVID, our revenue growth was primarily driven by volume. We're investing in innovation and commercial programs to ensure healthy long-term growth, and I'm confident that volumes will eventually increase. Mike Hsu replied, our volume trends are improving, and we are starting to cycle the pricing initiatives that were more front-end loaded last year. We expect the contribution of revenue from price to diminish, while the contribution to revenue from volume and mix should continue to improve. I cannot give an inflection point, nor will I forecast or give guidance on one. Nelson Urdaneta replied, I can tell you that we've seen an improvement in volume over the last couple of quarters, going from down 7% to down 3%. This is due to pricing, innovation, and increased investments behind our brands. We expect revenue growth and management realization to be less of a driver, and we anticipate positive volumes in the future. In terms of operating profit, we have a slightly better performance in the first half and better outlook on costs, which is equating into better performance on the outlook for EBIT. For EPS, there are a few puts and takes in the quarter, but we're still expecting the tax rate for the year to be in the 23% to 25% range. Goldman Sachs analyst Jason English inquired, do you accept the market share losses or do you plan to close the price gap to regain it? Mike Hsu replied, I think we've seen list prices move, but there has been higher promotion in some markets, particularly in Latin America. We're being smart about it and investing in our GMK capability to make wise investments around promotion. Our goal is to grow market shares over the long term, and that's why we're focusing on innovation and commercial programs. We need to improve in this area and we're committed to doing that. UBS analyst Peter Grom inquired, what is the outlook for gross margin in the back half of the year, given cost pressures and productivity? Nelson Urdaneta replied, we've seen 2 quarters of strong gains in gross margin, reaching 34% in the second quarter. We expect to continue to make gains in the back half of the year, but not at the same pace as the first half. We anticipate a year-over-year gain in gross margins and an implied number of 250 basis points. We have not changed our outlook on currency impact, expecting $300 million to $400 million of inflation in currency and $200 million in other costs. Mike Shu replied, "Our outlook reflects the strength of our first half and the confidence in our underlying plan. We have seen healthy demand, strong innovation and a stable cost environment. While there is still economic and political uncertainty, we are seeing glimpses of reversion and sporadic supply challenges have improved. Overall, we feel very good about where the business is and where we're going in our outlook." UBS analyst Peter Grom inquired, "Given the cost pressures on the horizon, what is your view on when you expect to return to the 35% gross margin target?" Mike Shu replied, "I'm pleased with our progress on margin recovery. We've seen our gross and operating margins expand, and we're on track to restore our margins to 2019 levels. Once we reach that goal, we'll continue to work on expanding our margins through revenue and cost management." Mike Shu replied, "Thank you for joining us today. We are excited to share our progress with you in Q3 and look forward to seeing you then."